Everyone's talking about AI and ML in trading. They say it can make you rich. Some real numbers back that up. One hedge fund turned $1,000 into $90 million using machine learning over 3 decades. But here's the twist nobody tells you. Retail traders using AI bots lose money 77 times more often than regular traders. Same technology, wildly different outcomes. So today, we're not guessing. We're looking at real data, real firms, real numbers. Real failures, too. By the end, you'll know exactly where AI and ML actually make money and where they quietly drain it. Let's be honest up front. No algorithm guarantees profit. Markets are unpredictable by nature. Here's proof. In 2026, AI models competed in a live trading contest called Alpha Arena. Out of 32 test rounds, models finished in profit only 6 times. The portfolio lost about 1/3 of its capital overall. These were frontier AI models, built by major tech companies, and most still lost money. So if a cutting-edge AI can lose in live markets, remember this. Any tool promising guaranteed riches is selling a fantasy. What AI and ML actually offer is different. Speed, pattern detection, consistency, not certainty. Quick refresher, since this matters. AI is the broad system. It reasons, plans, and can explain decisions. ML is a part of AI. It specializes in finding patterns in historical data. Think of AI as an analyst. It reads news, reports, and sentiment. Think of ML as a calculator. Fast, narrow, and built for pattern recognition. In real trading firms, they work together. ML crunches the numbers. AI wraps around it to act and explain. Now, let's see what that looks like with real money on the line. Meet Renaissance Technologies, founded by mathematician Jim Simons. Their fund, Medallion, is the most successful hedge fund in history. From 1988 to 2018, it averaged 66% annual returns before fees, about 39% after fees. Every single year for 30 years. Here's the wild part. During the 2008 financial crash, when the S&P 500 fell 38%, Medallion returned 74.6%. In 2020, during pandemic chaos, it returned 149%. How? Machine learning models trained on decades of data, finding patterns humans could never spot manually, executing hundreds of thousands of trades a day. This fund is closed to outside investors, but it proves what disciplined ML can do at scale. Renaissance isn't alone. 2 Sigma manages around $70 billion, built entirely on machine learning and data science. D.E. Shaw manages over $85 billion. One of its funds returned 28.2% in 2025. QRT manages about $38 billion. Its flagship fund returned roughly 30% in 2025. These firms don't call themselves traders. They call themselves technology companies that happen to trade markets. They hire physicists, not stockbrokers. They treat markets as a data problem, not a gut feeling problem. This is where AI and ML genuinely print money at massive scale with massive infrastructure. It's not just hedge funds. JPMorgan built an AI system called LOXM. It executes trades for clients automatically. Result? Roughly 20% lower trading costs, achieved through machine learning, not guesswork. Important detail, though. Every trade still needs human approval. JPMorgan doesn't let AI run wild. It uses AI to assist traders, not to replace their judgment. That single design choice matters a lot. Keep it in mind for the next section. Now, here's the part that matters most for you. Researchers at UC Berkeley studied retail trading bots. The result was brutal. Bot users lost 77 times more money per user than regular human traders. On another platform, over 80% of retail bot users lost money overall. Why such a huge gap from the hedge funds we just covered? Retail bots often use basic, static rules. They don't actually learn like real ML systems do. Many are simple scripts wearing an AI label. Meanwhile, real institutional systems have direct market access, massive compute power, teams of PhDs maintaining them daily. It's not the same tool. It just wears the same name. One more real story, because this matters. In 2012, Knight Capital deployed new trading software. A small deployment error reactivated old, dormant code. In just 45 minutes, the system placed millions of bad orders. The firm lost $440 million, almost overnight. This wasn't hype or exaggeration. It's one of the most cited case studies in finance. The lesson isn't avoid algorithms. It's algorithms need strict oversight. Speed without control is dangerous. Every firm we covered today invests heavily in that control. Most retail tools don't. Let's connect the dots. Winners? Firms with massive data, massive compute, and constant human oversight. Renaissance, Two Sigma, D.E. Shaw, JPMorgan. Losers, statistically? Retail users trusting simple bots to do it all alone. The difference isn't the words AI or ML on the label, it's the depth behind those words. Data quality, model discipline, human oversight, risk management. If you're a developer or trader exploring this space, that's your real takeaway. Build understanding first. Let tools assist you. Never let them replace your judgment entirely. So, will AI or ML make you rich in 2026? Neither by itself. Not reliably. Not for most people. The data is clear. At massive scale, with massive discipline, these systems generate real billions. At the individual level, without that same rigor, most users lose money. The real edge isn't the algorithm. It's understanding what it can and can't do. That's all for this video. If this video helped, subscribe so you don't miss it. See you in the next one.